Okay, picture this. On one side, you've got the pure Robo-Advisor. Sophisticated algorithms, diversified portfolios, low minimums, all very sleek, efficient, automated.
Right, accessible, often really affordable too. It's technology scaling, investment access.
And then the other side, that's your traditional human financial advisor. Personalized planning, advice for complex stuff, that human touch when markets go wild. But usually, higher fees come with that bespoke service.
It really is that contrast, isn't it? Tech for scale versus the depth of human expertise and maybe the comfort of having a person to talk to about your money.
Exactly. But, finance is rarely just black and white. So what happens when these two worlds don't just exist side by side, but actually merge when the automated engine gets a human co-pilot?
And that's precisely what we're seeing, the rise of the hybrid robo-advisor model.
Yeah, it's not just some idea anymore. Big financial players are really defining this space as we speak.
And our sources, they make it pretty clear. This is where those lines, between pure digital advice and traditional human advice, they're getting really blurry. Firms are adding humans to their tech platforms, and traditional firms are adding automation.
It's an evolution. Seems driven by what investors actually need or maybe what they want.
Definitely looks that way.
Which brings us right to you, listening in, trying to figure all this out. What does this hybrid model really offer you? Is it genuinely the best of both? The efficiency and low cost of tech, plus the tailored guidance of a human.
Or is it maybe a bit of a complicated middle ground? Does it end up not quite hitting the mark on either side?
That's the million-dollar question, isn't it? And figuring that out means really understanding what each specific hybrid service actually does.
Yeah, because as the NASA source points out, and this is crucial, the service levels, the approaches, they vary wildly from one provider to the next. Just hearing hybrid doesn't tell you much.
You got to look under the hood. And that is precisely what we're going to do in this deep dive. We're aiming to cut through that complexity. We've got a stack of sources here. The detailed Morningstar 2023 U.S. Robo-Advisor report, insights from regulators like NASA, industry thoughts from RFI Global, a NerdWallet overview, a really specific review of Vanguard's personal advisor services, and, this is interesting, some real-world user feedback from Reddit about Schwab intelligent portfolios.
A good mix of perspectives.
Yeah, so we're going to unpack this hybrid model. We'll really focus on how two of the giants, Schwab and Vanguard, are doing their versions of hybrid, how Morningstar rates them, and what the actual user experience looks like based on what people are saying.
Right, getting past the fancy marketing terms to see what's actually delivered, and helping you figure out which parts of this hybrid idea might actually matter for your own financial situation.
Okay, let's get into this evolution then.
Yeah.
So to really get the hybrid model, maybe we should quickly define its starting point, the pure robo-advisor. What did that first wave look like based on our sources?
Okay, so the pure robo, fundamentally, it's described as a fully automated digital investment platform. Its big appeal, and Morningstar highlights this, was really about access and efficiency.
Making investing easier for more people.
Exactly. They usually had very low minimums to start, sometimes practically zero, which opened up professional-style portfolio management to folks who couldn't meet the high minimums of traditional advisors.
Right.
Plus, their costs were typically pretty modest compared to humans, and the whole experience was designed to be super easy online. Streamlined tech.
So ideal for maybe younger investors or people with less complicated finances.
That's generally the idea. It democratized access to basic investing using technology.
How did it actually work? What was the process?
It usually kicked off with some kind of online questionnaire, asks about your goals, retirement, house down payment, whatever, your time horizon, when do you need the money, and crucially, your risk tolerance.
Ah, the quiz part. How much market craziness can you stomach?
Pretty much. That data then gets crunched by an algorithm. Sometimes they call it an advice engine. It takes your answers and recommends a portfolio from a preset menu it manages.
And those portfolios are usually
almost always built using low-cost, passive funds. Think ETFs, exchange-traded funds. The goal is broad diversification across different asset types, U.S. stocks, international stocks, bonds, maybe some other things, to manage risk without trying to time the market.
Okay, so you get set up, and then the platform just runs it, rebalancing and all that.
Precisely. The automation handles the day-to-day adjustments, keeping your portfolio aligned with your targets. And the NASA source is really clear here. With the pure model, there was little or no ability for customers to receive personalized investment advice from a financial services professional. Your interaction was just with the tech.
Got it. Pure robo. Efficient, accessible, tech-driven, no human advice. So now enter the hybrid. What's the big change?
The fundamental shift, like NASA defines it, is adding that layer of human interaction. The hybrid model adds a level of human interaction, allowing customers to work with a financial services professional online or in person.
So you still get the automated portfolio stuff?
Yes, the tech still manages the investments, but now you also get access to talk to a person for advice.
Not just tech support calls, like actual financial advice.
Yes, that's the intention, according to the sources. Morningstar mentions leading providers offer comprehensive tools ranging from just online help to actual on-demand access to human advisors.
Okay.
And they point to firms building these hybrid offerings, blending the automated tools with human advisor access for those deeper conversations. Ally Invest, Merrill Lynch, JP Morgan are mentioned as examples. It's really blurring those lines between robo and traditional wealth management.
But there's a trade-off, right? The NASA source mentioned cost.
Yes, that's key. Hybrid models generally cost more than the pure robos. That human access isn't free.
Makes sense.
But in return for that higher fee, you might get more. Maybe more portfolio customization than a pure robo allows, services tailored more to you, or just, the comfort factor of talking things through with a human.
Right, that personal reassurance piece. So why is that human element seemingly so important? If robos are efficient and cheap, why this big push towards hybrid?
Well, the data we have suggests the pure robo, while great for getting started, maybe isn't enough for everyone, or maybe not enough as your financial life gets more complex. Morningstar cites survey data, this is interesting, showing only about 5% of investors actually prefer only online advice. Just 5%.
Wow, only 5%. That really jumps out. It suggests that despite all the tech hype, most people still want some kind of human connection when it comes to their money.
It does, doesn't it? And it's not just potential customers thinking this way. There was a Vanguard survey mentioned in that Morningstar source. It found that a whopping 88% of current robo-advisor clients said they'd consider switching to a human advisor.
88%. Of existing users, that's huge.
Yeah. It's incredibly telling. It really suggests that maybe as people use these platforms or as their finances get more complicated, buying a house, having kids, inheriting money, they start feeling the need for human expertise that goes beyond just managing the portfolio.
Yeah, that makes total sense. A robo can follow instructions, rebalance, maybe harvest losses, but it can't really help you strategize complex tax situations or figure out stock options or just talk you off the ledge during a market panic.
Exactly. And the RFI Global source talks about this evolving landscape, how people are seeking financial guidance differently now. This move towards hybrid models seems like a direct response, acknowledging that automation is great for efficiency and cost, but there's still a massive demand for the planning, the context, the reassurance that a human can provide, especially for bigger life moments or as you build more wealth.
So the takeaway isn't really that pure robos failed, but more that the market realized, hey, there's this big group of investors who like the tech for the basics, but they also want a clear path to a human expert when things get trickier or feel overwhelming.
I think that's exactly it. The hybrid model is trying to bridge that specific gap, serve that broader market that values both the machine's efficiency and the human's guidance.
Okay, so we see the why behind the hybrid trend. Now let's talk about how we actually evaluate these services. That Morningstar 2023 landscape report seems like the go-to framework here.
It really is. It provides a pretty robust way to look at them, which is important because, like NASA said, these services can be quite different. Morningstar's framework looks beyond just the obvious thing, which is cost.
Right. So how do they break down their scores? What are the main pieces they look at?
They use 4 main components, each with a specific weighting towards the overall score. Price is a big one, weighted at 30%. Equally important is the quality of investments and portfolio construction. That's also 30%.
Okay, so cost and the investment strategy itself are weighted most heavily.
Correct. Then there's the provider, basically, the company behind the service. That's 20%. And finally, the breadth of services offered makes up the last 20%.
Got it. Let's quickly unpack those. What goes into the price score?
So for price, they're looking at the total cost to you, the investor. That means the advisory fee, the platform charges, sure, but also the underlying fees of the funds in your portfolio, the expense ratios. And importantly, any other ways the provider might make money off your assets, like, say, through cash sweep accounts.
Ah, okay, so it's the all-in cost.
Right. And importantly for price, a lower score from Morningstar is actually better. It means lower costs for you.
Lower score is good for price. Makes sense. What about that other big one, quality of investments and portfolio construction? What do they looking for there?
This is really about the investment engine itself. How do they pick the investments? What's the methodology for building the portfolios for different risk levels? How well do they match those portfolios to the right investors? They want to see rigorous research behind it all.
Avoiding dodgy strategies, presumably.
Exactly. Avoiding things like trying to constantly time the market or using weird, opaque investments. They value transparency and a sound, repeatable process for allocating assets and choosing the funds.
Okay. And the provider score, the company itself, what contributes to that 20%?
Here they're looking at the organization's strength and how well it seems aligned with client interests. Who's running the show? What are their qualifications? Does a firm seem committed to acting in your best interest? They also look at the parent company's stability and resources. Is this firm likely to be around and support the platform long term?
Right, the stability factor. And the last 20% breadth of services, this sounds like where the hybrid part really comes into play.
Absolutely. This category covers everything beyond just the basic automated investing. So access to human advisors is huge here. How easy is it to reach them? What are their credentials? How deep does the advice go?
Okay.
It also covers things like financial planning tools, tax services like tax loss harvesting, which we'll definitely get into, the ability to link outside accounts for a full picture, and just other features that help with your broader financial life, not just the investment account itself.
So it's a pretty holistic view: cost, investments, the company, and all the extras. Based on this framework, who came out on top in that 2023 report?
According to Morningstar, Vanguard and Fidelity Go got the highest overall assessments, and then Schwab Intelligent Portfolios, along with Betterment and Wealthfront, got above average scores. So still strong performers, just not quite hitting that very top high rating that Vanguard achieved.
Okay, that's a great benchmark. Let's use it now and dive into Vanguard. They got that top high rating. Specifically, let's look at their main hybrid offering, Personal Advisor Services, or PAS.
Yes, Vanguard. They've been in the advice game for a while, but these newer services, Vanguard Digital Advisor, VDA, and Personal Advisor Services, PAS, are their main digital plays now. And PAS, as you said, got that sole high overall rating in the 2023 report. That's a strong signal.
And PAS is definitely their hybrid flagship.
That's right. The Vanguard PAS review we looked at explicitly calls it a mix of automated investing and personal advice from a human. They do have VDA, which is more purely automated, lower minimum, but PAS is the main hybrid service.
Who's it aimed at? And what does it take to get in the door?
The sources suggest PAS is really for folks with more significant assets. The review mentions a $50,000 minimum investment to start, so that's definitely higher than many pure robos, positioning it for clients who've already built up a bit of a portfolio.
50 grand minimum. So not quite entry level. What kind of human help do you get for that?
You get access to certified financial planners, CFPs. These are advisors with pretty rigorous qualifications.
Wait, CFPs are a known standard.
Yes. And the review says clients can connect with them by phone, email, video chat. There's also a tiered system for support. If you have less than $500,000 with them, you get access to a team of advisors. If you have $500,000 or more, you get assigned your own dedicated advisor.
Ah, that team versus dedicated advisor difference is interesting. What about the advice itself? Is it just about the investments or broader?
This is where Vanguard PAS really leans into the comprehensive side. The review makes it clear the advice goes way beyond just managing the portfolio. We're talking in-depth financial planning goals, tax tips, advice on complex stuff like stock options, retirement planning, even estate planning.
Wow, okay.
And for clients with really high assets, like $5 million plus, they add trust and wealth planning services. So it really emphasizes that hybrid nature tech for the portfolio, but deep human expertise for your whole financial picture.
That sounds much more like traditional wealth management, but using tech to make it maybe more efficient or affordable than the old model.
That seems to be the goal. Now, the investment strategy itself, given its Vanguard, I'm guessing low-cost index funds are front and center.
Safe bet.
Very safe bet. Their strategy is classic Vanguard. They build portfolios mainly using their own low-cost ETFs and mutual funds.
Yeah.
The focus is on broad diversification, long-term investing, aligned with your goals and risk level, and they explicitly avoid frequent trading.
Makes sense. Did Morningstar mention any recent changes to their investment options?
They did. The report noted Vanguard recently added active equity and fixed income funds as options, alongside the usual index funds. They also added ESG strategies, environmental social governance for clients who want that. Those additions probably helped their high score for investment quality.
Okay, ESG is a big one for some people.
Another interesting point Morningstar mentioned was Vanguard's risk assessment. They use behavioral economics. So they look at your risk tolerance, how you feel about risk, but also your risk capacity, how much risk you can actually afford to take based on your situation and timeline.
So not just feelings, but facts too.
Right. A more nuanced approach, trying to match the portfolio to both your psychology and your financial reality.
That sounds pretty sophisticated.
Yeah.
Now, fees. How does PAS stack up, especially with that human planning included?
Generally considered competitive, particularly for this level of hybrid service. The PAS review pegs the advisory fee around 0.35% of assets if you're under $500K, dropping slightly to 0.30% if you're above that.
And the fund fees on top of that.
That's the Vanguard advantage. Because they use their own funds, those underlying expense ratios are super low, averaging around 0.06% according to the review. Tiny.
So the total cost is an advisory fee plus that very small fund fee. And Morningstar gave them the best score for price overall.
Yes, the only high assessment for price across all the robos they looked at. Now, Morningstar did mention a minor pricing misstep elsewhere about the digital advisor maybe not being the absolute rock bottom cheapest at the very entry level. But for PAS and the overall price score, Vanguard's combo of reasonable advisory fees for the service level and those signature low fund costs won them top marks.
That's a strong value proposition. Comprehensive human planning, tech efficiency, and low costs, especially for bigger accounts. What about tax loss harvesting? Is that included?
Yes, it is. Tax loss harvesting is a key feature. Morningstar noted it became available to all Vanguard advice clients back in November 2022. It's part of their strategy for tax efficiency and taxable accounts, selling losers to offset gains.
Okay, so summing up Vanguard PAS. Sounds like a high-quality, comprehensive hybrid. Aimed at folks with $50 K plus BSO wall key, offers real CFP planning, automated investing, low costs, tax efficiency, earning it that top spot for Morningstar.
That's the picture painted by the sources, yeah. It feels like a hybrid model that leans more towards the full-service wealth management side, just delivered more efficiently through tech.
All right, let's pivot now. Schwab Intelligent Portfolios, or SSIP, another huge name, but their approach, especially how they make money on the core service, seems, well, quite different.
Oh, it's very distinct, and this is maybe the most critical difference for listeners to grasp. Schwab SP got an above-average overall score from Morningstar. Good, but not top tier like Vanguard. But the fundamental difference, especially on cost, is how the basic SIP service works.
And that difference is, drumroll.
The headline is, the basic Schwab Intelligent Portfolios service charges zero advisory fee. None. You don't pay Schwab a percentage of your assets each year for managing the portfolio.
No advisory fee. How is that possible? How do they make money? There's got to be a catch, right?
There's not really a catch, but there's a specific mechanism, and this is key, highlighted by both Morningstar and those Reddit user comments. Schwab makes its money on SIP primarily by allocating a significant chunk of your portfolio to a proprietary cash sweep account.
Cash sweep. Okay, so break that down. Instead of investing, say, 100% of my money according to my plan, they hold some of it back in cash.
Exactly. And Schwab earns revenue from the spread on that cash. That's the difference between what they earn by investing or lending out that cash pool and the likely minimal interest they pay you on your cash portion. Morningstar explicitly notes this cash sweep is the main revenue driver, but it also drags on returns in up markets, because naturally that cash isn't invested in the stocks and bonds that are hopefully growing.
Okay, that's a really crucial point. So you're not paying an explicit fee, but there's an implicit cost and opportunity cost. Your money held in cash might earn less than if it were fully invested. How much cash are we talking about? Is it a tiny slice?
Doesn't sound like it. The sources suggest it's a noticeable amount. Those Reddit comments were insightful here. Users mentioned seeing cash allocations around 11% depending on their risk profile. Some thought maybe it could be reduced to around 6% sometimes, but still significant.
11%. So on a $100,000 account, maybe $11,000 is just sitting in cash, earning next to nothing, instead of being in ETFs.
That's the potential scenario based on user reports and how Morningstar describes the model. And it's definitely something users on Reddit talk about. They express surprise, sometimes concern about how much cash is held, and they directly connect it to the lack of an advisory fee.
That's why it's free.
Basically, yeah. As one user put it, cash withholding is why you don't pay a management fee. It's still your money. It might earn a tiny bit of interest, but it's not working for you in the market in the same way invested assets are.
That's a fundamental difference people need to understand. Okay, putting the cash piece aside for a sec, what about the actual investment strategy? How did Morningstar rate their portfolio construction?
Morningstar rated SIPS's portfolio construction as above average. They use a pretty detailed risk questionnaire. Morningstar said over a dozen questions to slot you into one of 12 risk levels.
12 levels, okay.
And the portfolios are broadly diversified. They use ETFs from lots of different companies, not just Schwab funds. Morningstar's tables showed ETFs from iShares, Vanguard, Schwab itself, even Goldman Sachs, covering things like U.S. and international stocks, different kinds of bonds, REITs, commodities, plus that cash component, of course.
Diversified, but always with that cash slice baked in. Now, the hybrid part getting human help.
Okay, so Schwab layers that on with their premium tier. Schwab Intelligent Portfolios Premium. This adds access to financial planning calls and guidance from a human advisor.
Ah, so it's an add-on service.
Exactly. And like Vanguard PAS, it has a higher minimum $50,000 to get into premium. Morningstar also notes there's a one-time $300 planning fee for premium in the first year. After that, the ongoing annual fee, at least for the hypothetical $200 K account Morningstar looked at, was actually reported as lower than some competitors. So it's a different pricing structure for human access compared to Vanguard's percentage of assets fee.
Right, a flat fee component versus AUM fee.
Yeah.
Got it. What about other features, ESG?
According to Morningstar, Schwab Intelligent Portfolios does not currently offer ESG options. So that's a clear limitation if that's important to you, especially compared to Vanguard, who does have them.
Okay. Tax loss harvesting.
Yes, that is a feature of SIP. It's available for accounts that meet that $50,000 minimum. Morningstar mentions it, and some Reddit users definitely highlighted it as a positive, valuable, automated feature for taxable accounts.
I seem to remember the Reddit comments also had some issues or complexities with it.
Yes, that's a really important piece of user feedback that came through. While automated tax loss harvesting sounds great, multiple users on that Reddit thread reported that Schwab's specific way of doing it generates a very high number of trades. Lots of transactions.
Why is that a problem?
Especially in taxable accounts, that high volume can make tax reporting a real headache come April. One user specifically mentioned getting hit with unexpected large taxable gains at year-end because of all the automated trading activity.
Huh. So the automation designed to help with taxes could actually make filing more complicated.
Potentially, yeah. The system works by selling a loser, then quickly buying something similar but not identical to avoid the IRS wash sale rule. That part works. But doing that frequently across many holdings can create a very long, complex list of transactions on your tax forms compared to just buying and holding or simpler strategies.
That's fascinating, a real-world consequence you might not think about. Let's talk more about that Reddit feedback. What was the overall vibe? Did people think Schwab's IP was worth it?
You know, Reddit, it was definitely mixed, very dependent on what the user valued. Performance experiences varied. Some were happy, others were disappointed, especially if they were comparing it simplistically to something like just holding the S&P 500 index, which SIP isn't designed to track directly because it's much more diversified.
Right, apples and oranges comparison sometimes. What were the arguments for it being worth it?
People who really valued the automation itself, the set it and forget it aspect for managing the portfolio, the rebalancing, and that automated tax loss harvesting, if they qualified, they often saw the value. It imposes discipline, stops you from fiddling.
Takes emotion out of it.
Right. One user who said they were a CFP even argued against just holding the S&P 500, saying the diversification and rebalancing SAP does are fundamentally good investing practices that the platform automates for you.
Okay. And the counter-arguments. Why wasn't it worth it for some?
The big things seem to be that cash drag people worrying about its impact on returns, especially when the market's running hot. Performance relative to simpler benchmarks was another theme. And, as we just discussed, that tax reporting complexity from all the transactions was a major pain point mentioned by several users with taxable accounts.
So it sounds like the value really boils down to whether you prize the automation and features like TLH enough to accept the trade-offs, the cash drag, and maybe more complex tax forms.
I think that nails it. And one user made a great point about the long term. They said consistently adding money over time led to positive returns for them, suggesting that maybe the platform just helped them stick to the most important behavior, saving regularly. That might have outweighed the performance drag concerns in their eyes.
That's a fantastic reminder. Consistent saving is usually the biggest driver. So yeah, the user feedback really adds that practical layer to the model, showing the realities of the cash allocation and the automated features.
It absolutely does. It gives you that lived experience beyond just the official report.
Okay, so we've explored Vanguard PAS and Schwab SIP in detail. Let's try to synthesize this now. Based only on what we've discussed from the sources, let's compare these two big hybrid players head to head. What are the key similarities and, probably more importantly, the crucial differences?
All right, let's line them up. First, that Morningstar overall rating. Vanguard PAS got high, Schwab SIP got above average, so a slight edge to Vanguard in Morningstar's view based on their framework.
The fee model, probably the starkest difference.
Absolutely, totally different philosophies. Vanguard PAS, explicit advisory fee, percentage of assets, plus those super low fund fees. Transparent cost structure, earn them the top price score. Schwab SIP, no advisory fee on the core service. Revenue comes from that significant cash allocation, which Morningstar noted could potentially hinder returns. It's about how you prefer to pay.
And getting the human help, the hybrid part, both need $50K minimum, but it works a bit differently.
Correct. Both have that $50,000 threshold. For Vanguard PAS, that's the entry point for the whole service, including the human advisors. For Schwab, the $50K is the minimum for the premium tier, which adds the human planning calls on top of the basic, no-fee automated service.
And the type of human advice seems different too.
Yes. Based on the descriptions, Vanguard TAS seems geared towards more comprehensive, integrated financial planning taxes, estate planning, complex decisions, dedicated advisors for higher tiers. Schwab Premium offers planning calls and guidance, but maybe sounds a bit less deeply integrated or holistic compared to the PAS description.
Tax loss harvesting both offer it, but maybe different experiences.
Both have it, which is good for taxable accounts. Schwab requires the $50K minimum for SIP. The main difference highlighted by users was that potential tax reporting complexity from Schwab's high transaction volume, which wasn't mentioned regarding Vanguard.
And that cash allocation piece is really unique to Schwab's core model.
Fundamentally, yes. The Schwab model relies on it for revenue. Vanguard's portfolios are designed to be fully invested according to your allocation, though they offer separate cash accounts, of course. That's a core structural difference.
Investment options also had a key difference.
Both use diversified ETFs, low-cost approach generally. Vanguard scored higher on investment quality from Morningstar. And crucially, Vanguard offers ESG options and active funds now. Schwab SIT does not offer ESG.
Provider-wise, though, both are solid, established names.
Exactly. Both are huge, well-known financial institutions. That gives a certain level of confidence in their stability and resources, which helps their provider score for both.
So the big picture, comparing them. Both are hybrids, blending tech and humans, but they go about it very differently. Vanguard has explicit fees for comprehensive planning and low-cost fund management. Schwab has no core advisory fee funded by cash allocation with human help as a paid add-on.
That's probably the single most important distinction for an investor to really get their head around when looking at these two specific options. It affects cost, potential return, everything.
And we should remember, this hybrid trend goes beyond just Vanguard and Schwab.
Definitely. Morningstar mentioned others like Ally Invest, Merrill Lynch, JP Morgan getting into the space. It's a broader industry shift. And NASA's warning holds true across the board. Service levels, portfolio strategies, they'll vary a lot, even among services labeled hybrid.
Okay, so let's bring this home. For you, the listener, trying to navigate your investment choices, what does all this mean? How do you use this information about hybrids and Vanguard versus Schwab to make a decision?
Well, it means you've got more choices, which is good, but you need to be really clear about what matters most to you. It's not just computer versus human anymore. It's more like, what specific blend of tech efficiency and human expertise fits my needs, and how do I want to pay for it?
Let's maybe walk through some key questions you should ask yourself based on the differences we found.
Good idea. First off, check your assets. Do you actually meet that $50,000 minimum for Vanguard PAS or Schwab Premium? If not, those specific options might be off the table for now. You might need to look at other hybrids, pure robos, or just keep saving.
Then think hard about how much human help you really want or need.
Yeah, this is huge. Are you mostly okay with automation and just want someone to call occasionally with a question? Or do you have a complex financial life, maybe multiple income sources, future inheritance, tricky taxes, multiple goals where you really want deep, ongoing financial planning with an advisor or team? Your answer points towards different service levels.
How do you feel about those different fee models?
This is that core Vanguard versus Schwab difference.
Oh.
Are you okay paying an explicit advisory fee, knowing exactly what it is, like with Vanguard? Or do you prefer Schwab's no advisory fee model, accepting that a chunk of your money sits in cash, potentially impacting returns? You need to be comfortable with how the provider makes money from you.
What features are must-haves for you?
Right. Is automated tax loss harvesting critical because you have a big taxable account? And if yes, are you prepared for potentially more complex tax reporting like some Schwab users found? Is having an ESG investment option non-negotiable? Make your list.
And finally, how complex is your overall financial situation now? Or maybe how complex do you expect it to get soon?
If things are complicated business owner, lots of outside assets, need estate planning help, then maybe the deeper planning from a service like Vanguard PAS makes more sense. If things are pretty straightforward, maybe a less comprehensive hybrid or even a pure robo is fine, at least for now.
So it sounds like the best hybrid isn't a single answer. It's totally subjective. Depends on your assets, your need for planning, how you feel about fees versus cash drag, what features you need, and just how messy your financial life is.
That's exactly it. One size definitely does not fit all here. And no matter which digital or hybrid service you're considering, that advice from NASA about due diligence is absolutely essential.
Remind us, what does that due diligence involve?
It means checking their registration. Are they properly registered with the SEC or state regulators? Look for any disciplinary history. Research the company, its leaders, its stability, and read reviews like those Reddit comments. They can give you valuable clues about the real-world experience, things like tax reporting or customer service.
And be pushy about transparency.
Yes. Understand exactly how they charge you, how they make money from your assets, and what their investment approach really is. Ask questions until you're completely clear before you hand over your money.
So wrapping up, the hybrid robo-advisor model is clearly a big deal, evolving fast, offering this blend of tech and human smarts. But as we saw with Vanguard and Schwab, hybrid doesn't mean just one thing. They have really different approaches to pricing, revenue, advice depth, features, everything.
And the right choice for you really comes down to understanding those differences and matching them to your own situation, your comfort levels, and how you prefer to get and pay for financial advice.
It leaves you with a final thought, doesn't it? As tech keeps accelerating and our financial lives maybe get more complex, what will the ideal advisor look like in the future? More machine, more human. Or maybe this constantly evolving, personalized blend tailored just right for each of us.
It's the question these hybrid models are already making us grapple with today.
Thanks for joining us for this deep dive into hybrid robo-advisors. We really hope exploring Vanguard and Schwab gives you some useful things to think about for your own investment journey.